So I was talking about the oil futures, and we can see here all the way out to July 2022, you can still buy oil below $40. And we know the frackers in the States basically need $40 and all. I talked about this in previous videos anyway. So, and you know, you're seeing your large companies, tar sands, you know, you're looking around probably 30, 35. You can look at that video anyways. So, of course, I'm using that as an economic indicator and also completely staying away from oil. I think there could be some good investments, but I think we need to get everybody back to work and get the surpluses dealt with. It seems like OPEC right now can't really control the price unless they really do drastic cuts, and that affects so much of the OPEC members. I don't think they could come to an agreement on that. So that was just that. I won't go too much more into the market. We'll see what happens next week. The futures, last time I checked, are still screaming higher for Monday, looking like another 3% day. So we'll just have to see if maybe the sentiment turns during the week. If not, I guess I'll just have to kind of move more to the long positions, knowing that things roll over. I'll have to get out. But I am trying to buy low beta companies that gives me a bit of a lag, right? Which I will get into now. Last week I bought Kraft, which is, everybody knows about Kraft, you know, macaroni and cheese. It's the third largest food producing company in the United States, and it came across my attention just because there's more people now actually going to grocery stores. We know most restaurants are closed. Kraft was lagging a little bit because people are eating more what they call the outside of the grocery store, you know, where all the healthy food is, and Kraft is more in the middle of the store. But taking that into account, I'll bring it up here. The symbol is KHC, and I'll bring up the weekly chart. So Kraft kind of spun off. Kraft was at $95 a share at that time, paying maybe a 2% dividend, and we've had like these huge legs down, like 1, 2, 3. Usually I go 3 legs down, and I figure that's the bottom. This is actually did a 4th leg, and we've stabilized out here in the 33, went all the way down to 20, and I'll go back now to the daily chart, and I ended up, so we got down to 20, ended up buying around here at 28, so I'm just kind of in the money on it, but it's paying a 5.6% dividend, and I think that's quite secure. And with the uncertainty right now, if I can get a fairly secure 5.6% dividend, I'm happy with that. And there's also a chance, because this was at $90, I mean, you know, a couple of years, it could get, even if it took 10 years to go back to where it was just a year ago, you're going to have a really good return. And even if it just goes up to 40 or 50, which isn't unreasonable, with your 5% dividend, you're getting 6 or 7% capital gain. It could turn into a very good investment that you can just basically forget about. Of course, the big risk is if they can't pay their dividend, but I think that is secure. Like I say, people, if anything, are shopping more at the grocery stores. And they did cut their dividend. Right now it's $1.60 per share, and it was over $2, so I think it's going to be pretty safe. I haven't done a lot of deep analysis on it. One thing I was a little bit troubled about is the amount of debt. It's around $20 billion, if I remember correctly. So long as they can roll that debt over at a reasonable rate, and I think they will be. I should have gone to Moody's and actually checked what the ratings were at, but something I might do next week. Again, this is just a new stock, and like I always say, I edge into my position slowly. One, you're never going to hit the bottom, and you got to slowly learn about the company, and that takes time. So I might add to it if it moves up a little bit more. And one thing, I don't expect it to move up a lot right away. So to actually give myself, you can look at it several ways, but I kind of look at it as bit as manufacturing a dividend. I did a covered call at $32.50 for $1.35, and that expires in October. So I said the dividend is $1.60, and I'm getting $1.35, which is, and that's only like half a year out. So you're almost doubling your dividend, or more actually, if you annualize that. And so doing covered calls on kind of boring companies that are paying dividends can work out pretty good. Of course, if everything turns around quickly and this takes off to anything above that price, my shares will be taken away at 32.5, even if they're trading at $40. But I'm looking at this more as an income play. I'm not really looking right now as a capital gain play, especially when I said previously that I expect the market to go down. And when it does, I'm hoping this might drop, to 27, 28, but I can hold on to it. And I can also look at that $1.35 has actually lowered my price from, what did I say, 28 something minus $1.35. So was that 26.65 or something? So anyway, so that was one. The other one I'll talk about a little bit is, find it here. It's actually a preferred share, and which I've done before. I've had some luck with preferreds. Oil crashed, what did I say, a couple of years ago we went through the same thing. They tried to put the frackers out, oil got hit, and a lot of oil stocks use preferred shares as a vehicle for financing. And at the time, it's like everybody, probably because you can get preferred share ETF, there was just all this selling. And I also took down some companies that were completely outside of the oil sector, like insurance and stuff like that. So I ended up buying some preferred shares at a pretty good discount and yielding like 6.5%. And then the price came up, and I got a capital gain too. And I just actually sold those out when I said I went mostly to cash. So they gave me a pretty good stable return. And preferred shares, as I'll get to, typically trade kind of a separate entity from the market and bonds. So it gives you a bit of protection that way. Though you can see this was pretty volatile. We dropped down to 1950, and now it's came pretty much back to where it's been trading at. So they can be volatile, they can follow the market, but sometimes they don't. And I do have a spreadsheet that I made up just for preferred shares, just kind of a checklist. Now this is what they call a perpetual preferred share, and it's the most popular, and the investor receives a fixed dividend either in perpetuity or until redeemed by the issuer. Perpetuals can be redeemed by the issuer according to a redemption schedule, usually 30 to 60 days. Perpetuals are typically redeemable 5 years after the issuance at a premium, after which the redemption price declines annually till the security is redeemable at par. Only the issuer has the right to redeem, so they're not perpetual preferred shares. Perpetuals often provide the highest yield, which I want right now, amongst all types of preferred shares. There's lots of different types of preferred shares. There's ones that will give you a spread, or so much above the Fed rate, or something like that. So perpetuals are the most sensitive to change in level or prevailing interest rates. So if interest rates did come up, I'd have to watch this closely, but I think the last thing we're going to see is interest rates coming up over the next 6 months. Maybe they will if we end up in huge inflation because of all this money printing, but I'm pretty sure this is, we're trying to get the economy, the Fed's trying to get the economy going by bringing rates down to zero, and we already know there's about 12 trillion, probably more now, and actually negative yielding rates around the world. So as I